Hey everyone, welcome back to Corporate Decoder, the place where we decode the inner workings of the corporate world. And today we're diving into a filing from Cycurion Inc. that might be a bit more interesting than it first appears because it seems like they're changing up how they handle their company shares. So what we have here is a Form 8K, which is basically a report for big events that happen in a company. And the big event for Cycurion is the creation of something called Series G convertible preferred stock. Now, don't let the fancy name scare you off. Think of it like this. The company is creating a new type of stock, and this filing tells us all about the special rules and features tied to it. This new stock, Series G convertible preferred stock, has some specific things about it. For starters, the company has authorized or made ready 10,000 shares of this new stock. Each share has a basic value of $0.01 per share, which is a tiny amount. Now, about how these shares can be used. Holders of this Series G preferred stock get to vote. They vote as if they had already converted their preferred stock into regular common stock, the kind you or I might buy on the stock market. They also get to vote as the law requires and as specifically laid out in the official document that describes this new stock. When it comes to dividends, which are like a share of the company's profits, holders of Series G preferred stock are entitled to receive 12% per year on their stock's value. This dividend isn't paid in cash though. It's paid in shares of the company's common stock, and it's calculated based on how many common shares they would get if they converted their preferred stock. Speaking of conversion, this is a key feature. Holders can turn their Series G preferred stock into regular common stock anytime they want. For every one share of Series preferred stock, they get 1,000 shares of common stock. There are some limits on how much they can convert at once, like not being able to convert more than 4.99% or 9.99%, or 9.99% or 9.90 can convert at once, like not being able to convert more than 4.99% or 9.99% of the company's common stock, depending on certain conditions. This is a common way for companies to issue shares that can be converted later, often used in private financing rounds. If the company were to ever shut down or go out of business, people holding this Series G preferred stock get paid first. They get paid the value of their stock plus any owed dividends before any money goes to the regular common stock shareholders. If there isn't enough money to pay everyone fully, the available funds are split among the Series G holders based on how much they are owed. There are also special protections for these Series G shareholders. The company can't make changes that would hurt their special rights or preferences without getting approval from the majority of the Series G shareholders. This includes things like changing the company's basic rules, increasing the amount of this special stock, or making agreements that negatively affect them. The filing also mentions that this new stock is registered in Delaware on August 11, 2025. This means the company is officially creating this new class of stock. Now here's where it gets interesting. The company also makes a strong statement about its commitment to shareholder value and following Nasdaq's rules. They specifically say they've stopped all forms of what they call dilutive financing, generally means issuing more stock, which can decrease the value of existing shares. They acknowledge that past actions might have affected shareholders and that they are now focused on non-dilutive ways to raise money. This is a pretty big deal for investors who might have been concerned about their shares being diluted. Looking at their stock information, the company's common stock trades under the symbol CYCU, and they also have warrants, which are basically options to buy stock in the future, traded as CYCUW. Usually when a company issues preferred stock like this, it's often part of a private placement where specific investors are given these shares in exchange for funding. The focus on avoiding dilutive financing is a way to reassure the market, especially since this new Series G preferred stock is convertible into common stock, which could be dilutive if not managed carefully. The report is signed on August 15, 2025 by L. Kevin Kelly, the Chief Executive Officer. This shows the top leadership is aware of and approving these important changes. So what's the story here? Cycurion is putting in place a new class of preferred stock that can be converted into common stock. While this type of stock can be a useful tool for a company to raise capital, especially from venture capital firms or private equity, it also carries the potential to increase the total number of shares outstanding, which can dilute the value of existing shares for common stockholders. The company's explicit statement about ceasing dilution as they move forward, it signals a potential shift in their funding strategy, aiming for more sustainable growth without negatively impacting their current shareholders. From a Warren Buffett perspective, you'd want to understand why this preferred stock was issued in the first place. Was it to fund necessary growth or simply to keep the lights on? The commitment to non-dilutive financing is a positive signal, suggesting management wants to align its interests with common shareholders. However, the convertible nature of the preferred stock remains a watch point. If the company's common stock price significantly increases, a lot of this preferred stock could be converted, leading to dilution. So, while they say they're done with dilutive financing, this existing convertible preferred stock is still a factor to monitor. A key risk for shareholders is the potential for future dilution if the company needs more capital and the terms of this preferred stock allow for it under unfavorable conditions, or if conversion happens at a low share price. The opportunity lies in whether the company can truly execute its stated strategy of non-dilutive funding and achieve profitable growth that offsets any prior dilution. So our point, if the company's common stock price significantly increases, a lot of this preferred stock allow for it under unfavorable conditions, or if conversion happens at a low share price. The opportunity lies. Overall, Cycurion seems to be trying to rebuild investor confidence by signaling a change in its financing approach. The creation of convertible preferred stock is a common part of a company's capital structure, but the market will be watching closely to see if they can indeed grow without further diluting shareholder equity. Alright, that's our breakdown of Cycurion's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.